Hi everybody. Welcome to Trading Conversations. You are here, my friend, because you believe that profitable trading is one of the most efficient ways to attain financial freedom and can be achieved as long as you are willing to put in the hard work to develop your trading competency. Our goal with this show is to introduce to you the traders who have dug through the trenches and emerged at the other end. From the sharing of their trading stories, strategies, workflow, and best practices, I hope to help you shorten your learning curve as you embark on your journey towards trading mastery. Today's guest is a veteran trader and a retired hedge fund manager whose trading journey is definitely worth turning into a biography book, at least in my opinion. Despite owning a profitable legal practice in his early days as a lawyer, he abruptly sold the practice in 1980. And that was the year that I was born. And he dived full on into trading without really knowing what he was really doing. Over the subsequent 6 years, he blew up his account on multiple occasions and lost a total of more than Australian dollars, $750,000 during that period. However, he persevered through the entire ordeal and finally saw light at the end of the tunnel when he registered his first profitable year of trading in 1987. And he has not looked back ever since. In 1990, he started his hedge fund with about $20 million of his investors' money and traded it to nearly $1 billion over the next 20 years. And in December 2010, he registered the most profitable year of his career. And as usual, decided to abruptly end his hedge fund career on a high by returning about $943 million back to his investors. Since then, he has went into a semi-retirement mode. Instead of making more money that he can spend, he decided to turn his attention towards paying it forward by starting a trading school to teach budding traders on how to actually trade more profitably. Now, with almost 40 years of both painful and glorious trading experiences under his belt, I'm sure we'll be able to learn and get inspiration from his story. It's my pleasure to introduce to you Ray Barros. Hey Ray, thanks for joining me in this episode of Trading Conversations. You know that when I first heard about your story while having lunch with you in Hong Kong some time back, I really felt that it will be a great idea to turn your story into a biography. I have this feeling that it will become a classic trading biography that will continue to inspire budding traders and even regular people many years down the road. I know you have written a trading book before on the nature of trends, which talk about strategies and concepts for successful investing and trading. But have you ever considered writing a book to journal your life and trading journey as well?
Yeah, no, I'm afraid not. I'm a little bit shy when it comes to that. I'll let someone else do the biography.
I see. Now, well, that will be really value adding for our audiences this time around because I will get to interview and find out more about your life and your trading experiences. Now, I understand from you that let's go back to the really right from the start where you started your trading journey. I understand that you were actually a pretty successful lawyer and you had your own legal practice. But you abruptly decided to, or maybe if you correct me, if it's not abruptly, you decided to actually sell off your legal practice in 1980. Can you share a bit about this background story of why this happened?
Yeah, well, I think profit for me, yes, the practice was profitable as practices go, but I was spending so much time in managing the practice. I was less a lawyer than I was a manager of the firm. You're managing your girls. You've got a couple of partners, you manage your staff and so on. And, you know, it wasn't so much a legal practice, but a business administration. And that's not something that I enjoy at all. So I was looking for alternatives. I just didn't know what else to do with my life. And then one day my father-in-law said, come to Hong Kong. I'm going to show you how to make money. And I got started with trading.
Wow, fantastic. And you just decide on the go and just finish up your legal practice and move to Hong Kong and start learning and start to trade from there?
No, it wasn't quite like that. What happened was, I think I got very unlucky because I had one of these periods when I first started trading. I was supposed to go to Hong Kong for a couple of weeks, about a week or 10 days. I stayed for about 6 weeks, I think, off the top of my head, going back a long time. And in that period, gold, I was trading the gold tail market, the Chinese version of gold futures. And it was trading a very narrow range. So I was watching my dad buy the highs and sell the lows. And I thought, well, that doesn't make sense. Market's getting to this level. We should be selling that. And market gets down to that level. We should be buying that. And so that's what I did. And at the end of the period, I bought my wife a fur coat, a nice fur coat. I thought, wow, this is easy. Why am I struggling with my legal practice? What I didn't tell her was gold shortly broke out. And I spent about 90% of the profits on my wife's coat, but I lost whatever I held back, I lost. I didn't tell her that part. I remember walking up the mountain, and I said, darling, I think I should give up the legal firm, and which I did about 6 months later, I think it was, that we gave it all up. And after that, she had to support me for 7 years.
Wow. And I understand that you actually, for about 6 to 7 years, you were actually not making money despite selling off your legal practice and turning into trading full-time. Can you share with us a little bit more about that 6 years of experience as a full-time trader, selling off a profitable legal practice, but yet not going anywhere?
It's I think the story most traders go through, most successful traders go through. I think I lost the money I got from the legal practice in about 6 or 7 months, something like that. And then thereafter, it was literally my wife bringing money in the door and I was throwing the money out the window. And there were just countless times, and I just blew capital after capital. I remember one time, probably the last time I blew it up. It didn't mean I stopped losing, but at least I stopped blowing up the capital base. I had just lost my capital base for the umpteenth time. And I went to Chrissy and I said, darling, please, I promise I've learned my lesson. Just give me another $25,000 and I'll this time I won't disappoint you. And so Chrissy being Chrissy, she gave me the $25,000. I really don't know where she dug it up from. And that night I was, in those days, day trading the S&Ps, and Friday night tends to be the night where there's lower volatility. And I managed to buy every high and sell every low. Did what my father-in-law did many, many years ago. And at the end of that night, I'd blown the 25,000. I mean, it still brings, sometimes my memory brings a lump to my throat. And I cried. I literally cried. And many years later, Chris said, I heard you crying. I didn't know whether to come in and comfort you or whether I should come in and hit you on the head because you'd done it again. So that's the kind of ups and downs you get emotionally that I was going through in those days.
And which part of that 6 years painful journey were you in at that point in time?
Oh, that would have been going to about the 4th year.
Okay. So during the first four years, you had some winnings, you have some losings, but overall you were not making money.
I can say that I never had a winning year. Oh, sure, I had some winning trades and even some winning periods, but I never had a winning year.
And despite that episode on the 4th year, you still persevered on for another 2 more years?
Yeah. There's a part, I'm very lucky in one sense. I come from a family where basically our conditioning, our form, how would I put it? Our culture, the family culture is that you can achieve anything you want as long as you have the will. And that's built into us. I think in various ways, we're all successful. We're 8 brothers and sisters. So I've got 7 brothers and sisters. We're 8 in the family, and each in his own way has achieved success in his field through this hard work. I mean, it's just, there was never a belief you can't make it. You just got to keep plowing in. Now, I have to tell you, Philip, I was very lucky I married the woman I married, because if she hadn't supported me, if she hadn't come up with the dough, hadn't come up with the money to send me to Pete Stettlemyre, which basically transformed my trading. She was living on, luckily we owned our home, or thanks to my father-in-law, because he gave us the money to buy our flat. But she was the one that came up with the money to go to Chicago. She was living on $5 a day. So any success I have here is largely her support. Had it not been for that, I wouldn't be here talking to you.
I see. Now, on that front, I think it is very applicable to many of our audiences. Many of them are thinking about potentially becoming a full-time trader and understanding that it is a huge risk to give up their career, become a full-time trader, while at the same time managing the expectations from the spouse and a livelihood. So if you were to be able to give some advice to anyone out there who's looking to turn full-time trader, and from your experiences, what would be the most crucial things to think about, especially in terms of financially as well as spouse relationship?
Okay. I think it's a great question, and it's a question I often get letters from wives saying, "Can you help me with this because my husband keeps losing money?" The first thing is you do not give up your job. You don't do what I did, essentially. You make sure you got some sort of income coming in order to sustain your trading, if I can put it that way, because if you don't, you're asking for trouble. The second thing is that you've got to be prepared, and again, this comes from my family, that you can't keep doing the same thing over and over again and expect a different result. Dad always taught us that if something's not working, then whatever you do, you've got to change it. You can't repeat the behavior that you're utilizing to produce a certain result and continue to expect different results if you keep doing the same thing. So that's another bit of advice I would give you. So they're the two things I would say. And thirdly, from the spouse's point of view, just be very understanding. The guy's trying. I hope he's trying anyway. He's trying different things. It's a long journey. Success won't come overnight. And just be a bit supportive.
And how would you suggest a way in order to let your spouse be more supportive in your endeavor, in your trading? Is there any suggestions for that?
Well, it comes down to communication. I mean, I did a course a long time ago on actually communication, nothing to do with wives. I don't know. Are you married, Philip? Are you?
Yes, I am.
Okay. One of the things that I found out in that course gave me the best advice I ever had as far as spousal relationships are concerned. This is about 20 odd years into the marriage. They said, women and men are different. When you ask me a question, Ray, blah, 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 what you're asking for is advice. Women aren't like that. What they're asking for is to be listened to. And what happens when a woman comes to you and says, I've got a problem, or you come to her and say, you've got a problem, I expect her to help me with the solution. She expects me to tell her more about the problem. So the advice that I was given in this course was, don't jump in and give advice. Listen. Ask her for a lot of information. So if she says, I went to the hairdressers and they burnt my hair. So what are you upset about? Is it because of the look of the hair, or your hair's been damaged or whatever, rather than jump in and give advice? And it was an interesting story because the first time I tried that, she said, we've been married 20 years and it's the first time you've ever listened to me. So there you go. That would be my advice. Listen to your wives and don't jump in and give advice. That's my nature, to jump in. Oh, I understand what you're saying. She hasn't even finished. I see the problem. Let me tell you what to do. Wrong,
I see. I see. So in a way, it is really about what you have been doing regularly to deposit emotional brownie points with your spouse, so that she will or he will be willing to give you the runway that you require in order to find success in whatever you do, not just in trading, I suppose, right?
Yeah, I think that's right. You're giving brownie points. I've got to tell you, in my marriage, that I didn't know this until 20 years into the marriage, long after 1980.
Wow.
And so I wasn't scoring any brownie points. I mean, she supported me because of the woman that she is. But I would certainly advise the blossoming traders, let's call them that, that they do deposit some brownie points. It's going to go a long way.
Fantastic. You're really a lucky man.
I am a very lucky man.
Okay, great. So now, during that 6 years, it was a very long journey of not being profitable. All right. So what gave you that persistence and endurance to last through that 6 years and living on the line? I mean, it's not like you have a very comfortable life during that 6 years. How did you manage to persevere through that?
Oh, I have to say, Philip, I think it's the family that I was brought up in. It never occurred to me that I was going to fail. It wasn't never a question of if, it was always a question of when. Of course, you did had some times when you thought, oh, do I really want to keep doing this? Do I really want to keep losing money? Especially when, dollars are tight and we don't know where we're going to be able to pay the next bill and so on. But overall, if you look at it as a big picture, I can't say that I ever got to a point where I was going to give it up.
I see. And so when was it that you started to see some light at the end of the tunnel, and how was that journey and experience like?
Well, it wasn't easy. I mean, we'd love to say it happened overnight, but it didn't. I count, there's a guy called Pete Stottlemyre. He's not around anymore as far as I can see. He used to run a school in Chicago called the Market Profile School. And I remember getting Futures Magazine and I saw this ad. I remember in those days, no internet. So I picked up the phone. I had a couple of friends in the States who were like me trying to become full-time traders and asked them, what do you know of him? And they gave him a huge rap. So I said to Chrissy, I've got to go to Chicago. And she said, look, I don't think we can afford it. Anyway, a couple of days later, she says, look, I can live on $5 a day, send you down there by economy class. You've got $10 a day to live on. That doesn't include the hotel. Can you do it? And that's how I went. And Peter taught me that markets are less about patterns and less about the win rate, if I can put it that way, and more about managing your expectations and managing the losses in order for the profits not to have to chase their tail. And if I can understand market price action, then that gave me an edge. And that's where it all started. It took me about 2 years of practicing market profile theory that I would actually say I had, well, it might have been even more, because I think I took the course about 83, something like that. And my first winning year was 87. So it might have been a few more years. It took me a while to get consistent profitability. But it was all due, in my view, it was all due to the learning I had from Pete Stottlemyre.
I see. And I understand the market profile is more for intraday trading, right? And so you saw your first profitable year in 1987. So can you explain a bit more about that particular year? What do you think are the crucial elements that help you turn profitable? And did you felt that in that year, that was the turning point for you already?
Yeah. Okay. Firstly, let's correct something. There is a misconception that market profile is for day trading. That isn't quite right. I won't go into it here because we'll be here all day. But just be aware that market profile started off as an intraday tool. But even right at the beginning, Peter had other time frame. He wasn't a big believer in day trading. He started day trading would give you good trade location, and then you would use other tools in order to see how it would go after that. You might call him a swing trader more than a day trader. I need to correct that. The other thing is 1987, more luck than good management. I happened to be short on Friday. I went short before the big crash, and I made a lot of money on the Monday. And that to me was the reason I made money in 1987.
I see.
But it did give me the feeling of success. And I remember thinking and recording in my journal at the time that I wasn't going to give this profits back, because in the past I had made some money, not quite as much as I did this time, but I had made some money. And so I said I wasn't going to give it back, and started from there. That 1987 did something. I'm not sure what it did, but it certainly gave me some funds, no question about that. But it gave me the feeling that I had turned the corner, that I was able to understand price action. And of course, being short was one thing. Getting out, learning to get out was a whole different ballgame. So 87 was the year that I started to perhaps register some self-confidence, or perhaps register the fact that market profile did give me an edge. I think that's the way I would put it.
I see. And how did you then continue to build on the success that you tasted in 1987? Because it took you another 2 to 3 years before you started your fund. So what was that 2 to 3 years journey like for you?
That was actually relatively, I would say relatively simple. I won't say it's easy. what caused the success or what led to those successes was simply the fact that I started doing the things that I knew I had to do. Keep my journal, exit a position if the market no longer gives me a reason. Better explain that a little bit. Pete didn't believe in stops. Pete Steademire did not believe in fixed stops in the market. He believed in exiting when the reason for the trade was no longer there. Now, I've always had a little bit of difficulty with that, so I have a fixed stop beyond which I'm not prepared to let the price go. I don't care how I think. But I have a lot of what I call soft stops. So if the market doesn't do something the way I think it ought to do, then I'm going to exit the position. Another thing that Pete taught me was that there are what ebbs and flows in your trading. So I call it the ebb stage. Everything I do is wrong. I ran through that this year, January. I think I'm getting out of it now. We'll see in the next few trades. But so certainly from middle January till recently, I was in an ebb stage where everything you do is wrong. Things that normally make money lose money. That's called ebb stage. Flow stage is where everything you do is right. You're God's gift to the trading world, I call it. And people let that run to their head. And then you've got the normal phase where your wins and losses, or your profits and losses are in line with your positive expectancy, with your stats. So Peter taught me that. So those two things really have helped the trading and helped me in from 87. I started recording, I'm now in ebb stage. In those days, all I did was cut my position sizing down. I do it quite differently now, but in those days it was just cutting the position sizing down so that I wouldn't lose too much. I'm in flow stage. I learned to increase my position sizing, and then I have a normal stage where it would just be the normal position sizing. So there are the things, the keeping of the journals and putting that ebb flow and normal phase into effect made the difference in those years. And at the end of 79, I think, 86, 87, 88. Yeah. At the end of 89, the broker I was with suggested I get into fund management. And that's how the fund started. No, it was the beginning of 89. Beginning of 89, middle of 89, he suggested I get involved with fund management. And in those days, we had CTAs. We didn't have hedge fund managers. We had commodity trading advisors. And you had to get a license, of course. And I didn't like the way you had to get money. We had to go to shows where there was a thing called commodity pool operator, and they would raise money for you and they would allocate it to CTAs. Problem was the CPOs would want to give it to people who had an established track record. They didn't want this young kid that's had 2 or 3 years and then multiple losing years prior to that money. They're not even what we call seed money, small amounts of capital. So I didn't go down that route. I went to a couple of shows. It wasn't very successful. So I was very lucky that my wife's family and my father was fairly well known in Hong Kong. So we raised that 20 mil from friends and relatives, and that started the whole thing.
I see. All right. So everyone who is watching into this interview recording that I'm doing with Ray Barros right now, before we go on to find out more about Ray's experiences trading his clients' money from 20 million Australian dollars to nearly $1 billion in 20 years, I would like to take this opportunity to let you know that Ray will be conducting a free live webinar on the 19th of April, 7:30 p.m. Hong Kong time. It's the same as Singapore time as well. And in this group coaching webinar, Ray will be sharing with you how to use my money method to achieve trading success. And on top of that, he will also share with you his personal 4-phase framework that you can use to build up your trading competency. All right, you can sign up for it at traderwave.com/Ray Barros. I'll be sharing with you the link in the video in the text as well. And I've already signed up for it. Okay, so you might want to do that as well. All right, now Ray, back to you again. So you had this opportunity to start a $20 million Australian dollars fund. And was it a very straightforward decision for you to take those money and start a fund? Or was that something that you think deeply about?
No question. The question was how much money I was going to raise. Because I had to talk to Chris here as usual, and we had a peculiar structure to in those days hedge funds that started to come about. The normal hedge funds in those days would charge you what they call an incentive fee, and then they would charge you a management fee, 1 or 2% per annum, calculate monthly in arrears, and your incentive fee was usually high watermark quarterly in arrears. In other words, you'd take whatever money you made and you'd get 30% of it, and it had to keep mounting, obviously. I never thought that that was fair for the client. If you think about it, because the client is, if you made money this quarter and you take 30%, the only way the client's going to get the benefit of that is if you distribute the money, because at some point that's the high watermark. It's going to recede. You see what I'm getting at? So what I did was say, okay, no management fee. I didn't have any overheads, and you were locked into the hedge fund for 3 years unless I lost 30%. At the end of 3 years, we would distribute the fund or close the fund down and distribute the assets. I would collect my 30%, and then they would be invited to come back in again. So we did that for about, I think, 6 years. And then they said, look, this is nonsense because we're all going to reinvest with you. So just keep it, take your 30% and stay. Now, I was very lucky. I have to tell you, looking back now, I had a lot of luck because I found a group of people that were willing to reinvest. I attempted the same idea a few years ago with some Singaporeans. And at the end of 3 years, we had, I don't know, we picked up 60% or whatever it was. It was over 50% return over the 3-year period total. And when I distributed the fund, not a single person came back. I was curious. I said, hey, how come you didn't come back? He said, well, you did it so easy, we can do it ourselves. That was that. So I have to say, I'm not sure that I would recommend this structure to people unless they really know you and you really know them, because it relies on people saying, okay, I'm going to give the money back to you. That's why most hedge funds will charge you quarterly in arrears and monthly incentive fee, management.
But I suppose that if you would have some kind of high watermark, then it doesn't really matter where you actually return the funds back to the investors and ask for them back as well, right? If they do need to take some money out, they can always take a portion.
No, that was the whole point. You see, they were locked in for 3 years. If you're talking about the normal funds, yeah, of course, they can pull it out. Normally, you can pull it out at any time. Although a lot of the funds do have, and people aren't aware of it, a lot of the funds do have a proviso which says that the fund manager can refuse they can freeze the fund for a certain period after you ask for a recall. That's I mean, this is the most famous one. I can't remember his name, but we had 2 people that made a lot of money in the 2007 crash, and one of the funds actually there was this clause, and he refused to let people out. And of course, everybody made money at the end. But a lot of the people that invested were very angry with him, and I don't know if his fund continued. One of the other guys did quite well. His fund is going on. I forgot John's last name, and short-term memory's gone. But so you got to be a bit careful with funds. If you are investing, just be aware that some funds do have what we call a freeze clause.
I see. All right. So you were initially managing just your own money, and after that, you move on to manage money from investors as well. Can you share a bit about that transition? Because I do believe that some of our audiences who are generally already profitable could be thinking about managing money for friends and even family members. So is there any particular advice that you would provide in order to make this transition easier and as well as to manage your investors' expectations?
Yeah, I think you've just said the most important thing. You're going to manage money for friends and relatives or for anybody, but obviously if they're strangers, you have less contact. But certainly friends and relatives, you've got to manage the expectations. Otherwise, you're going to be in for a lot of trouble. When I took this account up, I was pretty clear. I said, you're likely to lose a 30%. I told them up front. I'm asking you for help because you're my father's friend or whatever, or you're my father-in-law's friend. I'm asking for help. So it was pitched less on return and more on family relationships, guan jiu, as they call it over here. If you're doing it full-time, then I do recommend you probably avoid friends and relatives. If you can't manage your expectations, you're going to lose some friends.
I see.
Yeah. Trading, the key thing with trading is to establish the benchmark of how much you're prepared to lose. And it's money that they can afford to lose. Most traders walk into this game thinking, I'm going to make $1 squillion yesterday, never thinking of how much money they're likely to lose. And that's the wrong way to go about it. It's Peter and Paul. You've got to think of both.
I see. So in a way, when you raise that $20 million, you know that those $20 million are not funds that your investors crucially depend on them for their livelihood. It's something that of excess that they wish to generate risk-adjusted returns in a way.
Well, I don't know about the capital they put in, whether or not it was excess for them. I did know that they could lose 300,000 because it was about $1 million per person. And they could lose 30% of that because that was at 30%, then I would have to close the fund down.
I see. Can you share a bit more about your trading strategy before you raised that $20 million versus after raising that $20 million? Was there any significant changes in terms of the way that you trade the market, in terms of the instruments that you look at?
No, I have to say that one of the things that Pete taught me is that the amount of capital is irrelevant. What's important is the percentage of risk and the percentage return. So if you're trading $100, you're making 20% on that. That's what's important. If you're making $100 million, you're still looking at 20%. The difficulty can be, if you're not trading liquid instruments, is where you're going to watch your stops. Your slippage becomes important. So I always went for the most liquid instruments. In those days, I was trading gold, S&Ps, and that was it. And since then, I migrated over the years to FX because that's got a lot of depth. 30-year bonds, that's got a lot of depth. So I won't trade crude oil, for example. I won't trade soybeans. I was never really attracted to. That's a deep market. I think it's a deep market. It was when I first looked at it. But I won't trade things that are heating oil and crude oil. I won't trade silver, for example, simply because the markets are too thin if for the capital base that I have. That's something that you've got to be careful of. But apart from that, I traded the same instruments the same way. Basically, my approach has been, since I started trading, was market profile, which I saw as an extension of what I call the Wyckoff model. Those two things came together very nicely. And I've been trading that ever since. The details change as markets change, but the structure, the core principles remain the same.
I see. And what was the typical time trading horizon that you were using to manage those monies?
Yeah, I'm still probably about the same. If you're losing money, you get out pretty quickly. If you're making money, probably something like about 2 weeks.
Wow, that's a pretty short-term swing trading, right?
Yeah, it can be. It just depends on, like, if you're trading, for example, if you were trading the S&Ps and you managed cap part of that bottom, I would have been in it now for months because the market is, but normally you look at what the market is doing and it's giving you what, let's take a step back. Way I trade is I look for swing trades based on the Barros swing. So if you think about a one-period swing on a quarterly chart, if that has come to an end, then the monthly trend is going to change. So if I'm trading a weekly trend, we can do the same thing. If the monthly trend line is down and it's likely to change or to give sign of changing, then the weekly trend is going to turn up. So at that point is when I exit my short positions. May or may not go long, but I would certainly exit my short position. So 2 weeks is about the average. But as you know, with average, it measures the central theorem, the central core, but it ignores the values above and below. So as I said, if I'd been trading the S&Ps, I'd still be holding onto it. Now that's 3 months, and it looks as though it's still going up till probably May, at least May. So if I were long from February or March or January, then I would be holding for 5 or 6 months. But if I'm wrong, that's a more critical thing. If I'm wrong, I'm usually out. I try and be out within a few hours or within a day. The market has to do what I think it's going to do. Otherwise, I take the position out.
I see. So in a way, some of your most profitable trades probably last you a few months at least.
Yes, certainly if you're talking about the most profitable trades, the outliers. Well, yes and no. I was just thinking of the most profitable trade I've had this year. It lasted about 10 minutes. I was short the Aussie dollar, and for some reason in that quiet time period between about 5:30 and 7, we had this Aussie dollar tank 4 days ranges in 10 minutes, 5 to 10 minutes, came down and spiked up. If you look at the Aussie US chart, you'll see that spike down and spike up. I happened to be short. I saw it spiking down. I took the position out simply because I said, this is going to spike back up. I'd seen it before many times. So that was the shortest. But generally, the really good trades, the ones that return the most, will last a few months.
I see, I see. All right, so let's embark a bit more about your journey as you managed to fund over that 20 years. So I had a look at your equity chart in terms of managing from that $20 million all the way to about nearly $1 billion by the end of 2010. So in the midst of that 20 years that you were managing the money, there was this 3 years period where it was just going nowhere, and it could even be seeing some kind of a drawdown. So can you share with us a bit about what happened during that 3 years? Was it something about the market structure that changed, or was it something about you or your strategy that changed that caused that to happen?
I don't think it changed, and I can't blame the markets. At the end of the day, when you're trading, you're making the choices. The great thing about trading is the results are purely the results of your choices. I can't figure out what went wrong in those 3 years, if I can put it that way. In fact, when you say you're being very kind, when you said a bit of a drawdown, I almost hit my 30%. I think it was 25, 26%. It was my deepest drawdown in the whole time that I was trading. I can't say that I'm very grateful to the people. I said to Chrissy, when this 3 years is up, I'm going to lose these guys. I said I was very convinced I was going to lose them. And no, they all came back in again without, just said, don't worry. Okay, we've had some good runs. You stick with it. I don't know if I would have had another 3 years, they would have stuck with me, but they did stick with me for 3 years. And the reason I make that point is that if you're thinking of becoming a professional trader, like a hedge fund manager, if you take money from the public institutions like pension funds and so on, they won't tolerate those sort of losses. They won't tolerate that long drawdown. They would have been out ages ago. So that's one thing you've got to be very careful with. You've got to match your personality and trading style with your investors.
I see, I see. And the reason why I want to spend a bit more time having you discuss about drawdown is that drawdown is one of the things that negatively affect any kind of trader, whether it's new trader, even very experienced traders. And it is a very difficult period to actually to have that confidence, that faith that you can overcome that drawdown period, especially considering yours that went through a total of about 3 years. Can you share with us what are some of the things that you did that helps you to just continue to tide it through and have the confidence that things will turn out better? Or was it that throughout the whole 3 years, you really felt that this could be the last final year of you managing the fund?
Well, as we got close to the end of the 3 years, the thought that the fund would come to an end became more and more pronounced, obviously. When it first happened, didn't think too much of it. I'm in ebb stage, it'll pass. I managed my position sizing. I had some strategies which I'd added to when I'm in ebb stage. Then I think the second year, because that's going back quite a while, the second year was probably the hardest, because in the first year you think, okay, I'm having an extra long ebb phase. It'll pass. The second year felt as though, what's gone wrong? I spent a lot of time analyzing the journals, trying to work out if I'd been doing the wrong strategies. And with benefit of hindsight, you'd look back and say, well, honestly, I would have made the same decision. So lucky I cut my position sizing down. And in the third year, I started looking at trying to change the strategy a little bit. That didn't work. And by that stage, you kept thinking, well, look as though it's going to be my swan song. I'll just do the best to not lose money. I started focusing, probably incorrectly with benefit of hindsight, on not losing rather than just executing the plan as it was. I just got my position sizing very, very small. Don't forget that in that third year, I think off the top of my head, we were down 20-odd%. We lost another 3%. So, I was very close to that 30%, which would have been an automatic cutoff. So to me, they were hard years. I won't say I didn't think that. I never thought of quitting, but I thought that the people would pull their fund out. I think more important is if you look at, in a sense, your clients are lucky that we're having this conversation now, that January through to March, for example, and I've got this a site that I've done a partnership with a bunch of brokers called Axicor. It's an equation site. It's a public site where you can go in and see the actual trades for a $200,000 account. Initially I put 100,000, then I thought, well, I only want to lose 10%, so I took out another 30. But the actual base is a 200,000 base with 70,000 with the broker. I've had about 44 trades between now, since the beginning of January. I think we had about 8 winning trades, and we've had a lot of scratch trades. I haven't got the stats in front of me, but then we've had about 30 odd losing trades. I think, hold on a moment. Let me just get the stats for you. Let's be quick about this. Yeah, here it is. We've had 14%. We've had 6 winning trades, 22 losing trades, and 16% and 16 scratch trades in percentage terms. 14% winning, losing 50%, and scratch 36. By scratch, I mean losses less than $125 or less on this $200,000 account. And the whole account's down 1.26%. And the reason for that is the soft stops, not so much the position sizing, but the soft stops, because the moment the market doesn't do what I want it to do, I'm immediately out. And that's the difference saying between now and those years, many years ago, the quicker exit. And the reason why people don't get out quickly is because there's the fear, oh, the moment I get out, the market will go my way. And that's what stops them from exiting a position. And if your strategy is any good, most times it will continue going against you to your stop. Then you'll get stopped out. Then the market might go your way. But
so how do you deal with that then?
Well, the good thing is I'm out of the trade. So when the market gets back, hits my stop, and gives me a resumption of the trend. Let's say I'm short. So let's say I'm short the euro at the moment. So the market goes up, I'm sure, and I take out the stop. So the market doesn't do what I want it to do today. I'm out of the position. Market goes to my stop, stops me out, gives me a sell signal. I'm free to take it. Whereas if you wait for the stop to get hit and then you get a sell signal again, the problem there becomes, oh my God, I've just been stopped out. If I jump back in, I might lose it. Or you might get emotional and say, okay, market's going up, I'm going to buy it. And then the market turns around and goes down. I can't tell you the number of times I've seen traders do that, where they have a good position, they lose all their profit, market stops them out, then they get a sell signal, but they say, oh no, I was wrong, I'm going to buy it instead, and the market continues going down. That's what I'm talking about. And that's, if I had anything to tell your people watching this podcast, is to be very clear about the kind of methodology you have and how that methodology manages trades that aren't going to do what you think they're going to do. What are you going to do? Are you going to get out? Are you going to add to your position? See, my things, I don't add to losing positions. I'd rather exit and then look at take it again at a higher level if I get the right signals. Or I might reverse if I get the right signals. But I try and keep the losses down to such a small amount that it doesn't matter. It's no longer impacting my trading decision.
I see. Well, fantastic. So towards the end of that 3 years of drawdown, can you share a bit more about the turning point of you barely almost touching that 30% mark, and how do you actually recover from there? How was that entire experience like?
Honestly, it's pretty boring, because at the end of the day, I didn't even notice until midway through the 4th year, because we closed the fund down. I was very happy, initially that people had reinvested with me, which stopped the losing, but it didn't really enter my mind. Because my profits is fairly tiny. I make about 20 odd % a year. And generally and I remember, I think off the top of my head, you'd have to look at the chart, but it was a very gradual climb. It wasn't as though we had a big move and then we stabilized. It was sort of, the profitability came back slowly. So it crept up on me. I can't remember that I got overly excited and said to my body, oh God, I'm making money again. It wasn't like that. It was just, it's suddenly at the end of the year, oh yeah, we are up. Oh good, I've broken the thing. That's basically what it was. Oh good, we're out of bed. Hopefully we'll be back to flow soon. But I'll tell you what, that 3 years had more of an impact in the last year, when the last year that I traded in 2010 was one of those years where everything I did was right. And I said to Chrissy, I'm getting out. One of the things that Dad taught me, you should get out on the top. You don't get out when you're down, you get out at the top. People will remember you and like you better, right? I remember those 3 years. I said, I didn't like the way I felt those last, especially when I thought people were going to take back their money. I'm going to get out now, because invariably I'm going to go back to normal. I'm going to go back to ebb. And people are very funny. Investors are very funny, no matter how long they've known you. Once you establish a benchmark like that, because I went from making 20 odd % to triple digits. So they're going to start expecting, okay, he won't make triple digits, but he might make 50% instead of 20%. And when I get down to 20%, they're going to say, oh, what a rotten trader, you know? So I thought, no, I'm going to get out on the top. And
I see.
it was
So
good.
I remember that during the very last short few years of you managing your funds, that was where you actually see I see an explosive growth in terms of your profitability. So can you share more about that? And you mentioned that you had a triple-digit profitability in the last year of your fund before you decide to just end everything on a high note. What was that year like? Can you explain and elaborate a bit more? How were you able to achieve that kind of results?
Look, that was just the market happened to suit you get into those situations where, like now, everything I do is wrong. I'll take a loss and take a small loss and I'm out. In those times, everything you did was right. If I thought the market was going to come down, if I'm trading gold, I think the market's going to come down to 368. It goes to 368. I get filled and market then immediately goes my way. I don't have any market doesn't move against me. And yeah, you make some mistakes, but the market covers for you. Those are what I call flow. Literally, it was just a gigantic flow year. I've never had experience. I never have experienced since 1 year of flow. It was just a wonderful year. Most of that year was spent in reminding myself not to get big-headed, because I've seen this happen before. I think a couple of years ago, the first 6 months I'm at 26%, and then I entered into an ebb stage. I finished the year about 21% up or something like that. So that's what normally happens. You get an ebb flow, or you get a nice grinding year like we did back after the 3 years of hardship. You very seldom have this very exponential rise that continues for a full year. So what I did was basically had to keep level-headed, keep to your plan, keep to your position sizing rules. Okay, you're in flow stage. You're going to pyramid. You're going to increase your exposure, manage the trade, blah, blah, blah. Just a normal. Keep yourself on a day-to-day level. All right, you're in flow. You have rules for flow. Keep to those rules. Don't break them. Don't think suddenly things have changed. That was the key to that year. That year made more of an emotional impact than the 3 years of losses.
I see. So if you can remember, during that final year, was it really more about you having a really high winning percentage, or was it out of those outliers, profitable trades?
It was both, because I have a thing called the rule of three, which means I exit the first third as soon as I under certain conditions, and usually in a normal phase, the first third gets exited as soon as I have twice the stop. The stop remains where it is, so even if I get stopped out, I can't lose on the trade. Second trade's at a core profit trade, a core profit target, and these are two in normal situations where you make your money. Then you have what we call the last third, which I call the blue sky contract. A friend of mine termed it that way, and that can usually result in no profit. You have some profit, but you give it back because the market stops you out, maybe at break even or marginal profit after you've made a bit. So think of it this way: the market's you're in a sideways market. You've bought the bottom, the primary buy zone, right? Market goes to the primary sell zone, and you've exited 1/3, and then you've exited your core profit contract. So you got your last third, and then the market starts to come down, doesn't give you a sell signal, so your long gets stopped out with a little bit of profit, but not much. But sometimes that third contract explodes. So let's say, for example, you bought the S&Ps in January, and then you're still long. At this stage, would still be long on that last third, and you pyramid into these positions. So that's what was happening in that last year in 2010. I pyramided into a lot of long-term positions that got to some fantastic targets. So it was both getting in at the right price and also getting out, market allowing me to get out at those prices that were exponential. So it was both the win rate and the average dollar win.
So you actually did add on to your positions. Instead of taking profits, you actually added on. Or was it a matter of you taking your first part profit first off the table and then seeing that it continued to rally, then you went back in again? Was it a matter of that, or you
it's got to explain this a bit better. Let's talk about this webinar we're going to be doing. One of the conditions that we'll be showing you is that there's certain conditions which I call the IPM mode, when the market's moving directionally. In that situation, you want to make sure, and this is what Pete taught me, that you add to your positions. If you're in a sideways congestion, you buy the primary buy zone, sell the primary sell zone, and you don't do anything in between because the market's very choppy. When the market's moving directionally, you want to add to your position. Most people say, oh, I bought the bottom of the market, and then if you sell it near the top, you say, I've sold the top of the market, you think how clever I am. And Peter used to explode. He'd say, you dickhead, excuse the word, what are you thinking? You had this run from 50 to 200, and all you did was buy at 50 and sell at 200. You should be buying all the way up. So what happens is, as soon as you can break even, if you think you're in a directional mode, as soon as you can break even on the contracts that you have, then you want to add to your position, provided you get the sell signal, buy signal, or sell signal, of course. But you don't sit back thinking, oh, I'm a great trader because I bought the low and sold the high, rather than adding to it. So that's, I think, a key difference of what I do. I've always done, but now I do it much better, of finding the right time to pyramid.
I see. So in a way, you will keep on adding to your position if it tells you there's a new setups that is still maintaining the current direction.
If it's, I call it directional mode, it's moving directionally. It's not congesting. If it's moving directionally, yeah, as soon as I can break even on my existing positions and I get a new setup, I will add to my positions.
Fantastic. We'll let you share more about that during your live webinar. Yeah, sure. Now, let me move on to the part where you close down your fund. So after you close down your fund, I understand that you have been trying to run a trading school. How did that motivation come about, and how long did it take you after you closed down your fund before you decided to start this school to teach, coach and mentor budding traders?
Well, I've always been a bit of a ham. I love getting in front of a crowd and giving talks. So even before I closed the fund down, I had been invited to talk at various functions. And so 2010 finished, and then 2011 came around, and January, I think it was, January, maybe late January, I said to Chris, I'm bored. Oh yes, I'm still trading my own account. And a bit like Soros, we have family and friends accounts that we were managing, but I wasn't utilizing all of my time. And so I said, okay, let's try and set the school up. I had been teaching before that, but off and on. It wasn't a business. Just whenever I felt like it, I would do it. And the good thing is, when I first started that, it was easy. It was in Singapore. I remember it was just after 2000. A friend of mine came and said, okay, I'm going to give you a chance to give a talk. I think you should come and do it. And he had 2 people attend. I can do better than that. And by luck, I got a formula where I got, in those days it was Refco. We get involved with brokers and they help me market to their list. And we were doing 30, 40 people at one stage. And I couldn't market to save my life. And I've tried to pick up some skills in that regard. So it just grew. I have to tell you, I think I mentioned to you at lunch, and one of the things, I'm fairly transparent. The school has not been as successful as I would have liked to have been. And I did a course with Marissa Murgatroyd, and you talk about price of courses. It was $30,000 US for this course. And she taught me that one of the not one of the problems, but the problem for an educator nowadays, a marketing educator, is that this is a sophisticated market, which means that there's a lot of stuff on the net which is free, if I can put it that way, and people are being a bit afraid to be scammed. They've been made a lot of promises, but they're not kept. And the educators that are worth a dime tend to charge more than the guys that are scamming. These are the problems that we face. We have to overcome them. So the school grew slowly. I needed to get some marketing skills. And as my marketing skills progressed, the sophistication of the market increased. So it hasn't quite gotten off to a good ground. But we'll see. We'll see. I can't say it's been a total failure because I'm getting quite a few students, but not to the extent. I would like to be the Harvard of the trading world. That's my ambition, but I'm running out of time. I'm 73, and I figure I've got maybe another 10 years. So I've got 10 years to get this thing off the ground. I'd like to be now, let me rephrase that. And I don't want to sound egoistical or anything, but my peers respect me. I mean, you look at the books, the Drayton in Trading Mindfully. I'm quoted in a lot of books, Beth Steenbarger's books and so on. I'm asked to, like CME, Chicago Mercantile Exchange, they asked me to give lectures in Thailand and so on. So my peers recognize me, and I would like the retail client, the retail sector to recognize me. That's what success would be. Now, if I can do that, it means I've helped a lot of people.
Yes, definitely. In fact, I think Ray, you have experiences of your early part of the trading journey, having go through all those hurdles. Even while you were managing your funds, you had 3 years of drawdowns, and I suppose that this will be the final third test for you, where you just simply got the plug through, and then finally you will see light at the end of the tunnel. And I really do believe that, considering that kind of prolific trading history and experiences that you have over the past 40 years, I really do believe that there's a lot of things to be learned from what you have gone through. And I think that maybe through the live webinar, you will start to have a lot more people seeing the values that you see, and you being able to pass on whatever trading knowledge that you have to the next generation of traders. And I think that's really one of the things that you could potentially leave a legacy for, and really hope that you will continue to do this and not just give up, and which you have never done so. And I don't believe that you will do it this time around as well.
No, I think if you're the guy, thank you for all that. I really appreciate the comments. I might get my wife to write my eulogy. I think he never gave up. I think that would be something that you could say about me. He died a failure. He never gave up.
Yeah. So in a way, if you think back about it, do you sometimes wish that when you were such a prolific hedge fund manager, you wish that you were more high profile to the retail investors out there by doing more of those regular talks? Maybe it would have made it much more easier for you to reach out to them.
No, sorry, mate, I'm cutting you off. But I think when you're a hedge fund manager, your focus is on your clients and your fund. And when, like myself, we only had an accountant doing my books. We didn't have a marketing person. We didn't need one. But still, there's a lot of things you need to do. You need to check up. I've spent a lot of money. I've spent a lot of time and effort to be a better teacher and to be a better marketer. And I think that, and it's worthwhile. The question is whether or not I'm going to succeed like I did with trading. Because to me, it's exactly like a trading journey. I had acquired the skills, then they had to apply the skills, then I had to get the reward. So now I've acquired the skills, I've applied them. Let's see if I get the reward.
Yeah, exactly. So I'm sure your reward is going to be so much more intangible compared to the money that you have made throughout, but it's really leaving a legacy behind for those people who has been inspired by your journey and able to learn from what you have gone through. All right, Ray, thank you so much for today's interview. And I'm sure that many of the traders who's listening in to your recording would have got really inspired by the tough journey that you went through and the light that you see at the end of the tunnel. And I hope that is something that can apply to them. And I thank you so much for today's interview. Would you have any last 3 words of advice for the budding traders out there? Let's say that if you can go back right to that very first point in 1980 again, okay, compared to what you know right now, what are the 3 main things that you would have done differently if you had a chance to go back to 1980?
If I had to go back to chance, the first thing I would say is focus on the expectancy return formula, which is average dollar win multiplied by the win rate minus average dollar loss multiplied by the loss rate must be positive. What I see in today's traders, and of course the marketing that comes about, is they talk about 95% win rate and that sort of thing. It's nonsense. I mean, if these people could produce those results, they go to a hedge option. They go to pension fund. They go to institutionals. Money will be thrown at them. It's just nonsense. You're going to have losses. That's part of the game. Just make sure that your positive expectancy return is positive. That's the first thing. Don't worry too much about the win rate. Worry about the expectancy return result. The second thing is make sure you keep your journals, your equity journal, which is your stats, and your psych journal, which is the qualitative stuff. So you've got a quantitative journal and a qualitative journal, and never stop learning. Always review your trades, learn from your profits and your losses, your profitable trades and your losing trades, and so that next time you will trade better. Improve your decision-making process. We have no control over the outcome. That's one thing we don't have. We take a trade on a trade by trade basis. Tomorrow, I take a trade. I don't know if it's going to be profitable or it's going to be a loss. But I do know that over a large sample size, my positive expectancy return will make a profit. And that's what I think they should focus on.
Fantastic, Ray. Thank you again so much for your time this morning to share with us your trading experience.
Okay, cool. Thank you.
Great. So everyone who's who's listening in or watching in to this interview recording I'm conducting with Ray Barros, a prolific veteran trader as well as a retired hedge fund manager. So before we end today's trading conversation, I would like to remind you again that Ray will be conducting a free live webinar on the 19th of April, 7:30 p.m. Hong Kong time. Singapore time is the same. If you are keen to learn more about Ray's 4-phase framework to turn yourself into a proficient and profitable trader, you do not want to miss this webinar. All right, so head to traderwave.com/Ray Barros and sign up for it right now. That's it for now, my friends. I'm your host, Philip Teo, and I hope to have you joining us again in the next episode of Trading Conversations.